All right, let's talk about the world of finance. It can sound super complicated, right? Well, today we're going to demystify it. We're breaking down all those key terms you hear thrown around, stocks, bonds, you name it, all the way to the big banks that run the show. Let's just jump right in.
So, have you ever really stopped to think about how these massive companies get built, or what people even mean when they say they're investing in the market? It all comes down to a few key ideas. And trust me, this isn't just jargon for Wall Street traders. This is the stuff that makes our economy tick. And once you get it, you'll see the world of money in a whole new way.
Okay, so first up, where does all this action even happen? Let's talk about the arena.
All right, a stock exchange. Just picture a giant, super organized marketplace. But instead of selling, apples and oranges, they're trading pieces of companies. It's really the central hub, the meeting point where businesses can get the cash they need to grow and where everyday people, investors, can put their money to work.
So we know where it all goes down. Now, what exactly are people buying and selling? Well, at the very heart of it all, you've got two main things, stocks and bonds.
Okay, stocks. The best way to picture a stock? Think of a company as a giant pizza. When you buy a stock, you're basically buying one slice of that pizza. You now own a tiny piece of the whole company. And if that company does well, makes a lot of dough, so to speak, your slice gets more valuable. You're literally a part owner. This is why people buy stocks, right? For that potential long-term growth.
Bonds, on the other hand, are a totally different animal. If a stock is owning a slice of the pizza, a bond is like you're just lending the pizza shop some money. You're not an owner, you're a lender. The deal is, they'll pay you back with interest over time and then give you your original loan back when it's all said and done. It's basically a formal IOU, and it's generally seen as a much more stable, predictable thing.
So that's the key difference you really got to get. Stocks mean ownership. That means you have the potential for huge growth, but also, more risk. Bonds mean you're a lender. That offers a much more predictable, steady income, but usually with lower returns. It really is that classic choice every investor has to think about, growth versus safety.
All right, so stocks and bonds. We've got the fundamentals. But, the world of finance is always coming up with new creative tools. So let's level up and look at some of the more advanced instruments that are built right on top of these basics. So what if you could get the best of both worlds? The safety of a bond, but with the exciting growth potential of a stock. Well, that's where a convertible bond comes in. It starts out as a normal, straightforward loan, but it's got this cool special feature, a kind of superpower. The person holding it can choose to trade it in or convert it for a certain number of shares in the company. It's a real hybrid.
But what if you think a stock's price is going to move, but you don't actually want to buy or sell the stock itself? Maybe you just want the right to buy it at a certain price without being forced to. This is the exact idea that brings us to our next tool, options.
And options come in two main flavors. You've got a call option, which gives you the right to buy a stock at a set price. So that's basically a bet that the stock is going to go up. Then there's a put option, which gives you the right to sell at a set price, and that's a bet the stock's going to go down. See? It's all about having the option, the right, but not the obligation.
So, how does an option actually work? It's pretty much a three-step process. 1, you buy the contract. This locks in a price and an expiration date. 2, you just wait. You watch the stock price move. And 3, you make a choice. If you are right about the direction, you can exercise your option and hopefully make a profit. And if you are wrong, you can just let it expire. The only thing you've lost is the small amount you paid for the option in the first place.
And believe me, the rabbit hole goes deeper. You'll hear about things like warrants, which are kind of like options, but for a much longer term. And then there are structured products, which are like these custom-made investment packages. We're not going to get into the weeds on those right now, but it just goes to show you how these simple building blocks can be stacked up into some really complex things.
Okay, let's be real. Picking individual stocks and bonds, that's tough. It takes a lot of time and research. So how do most people invest? Well, instead of picking things one by one, they buy a whole basket of them all at once.
So yeah, how can you own a tiny piece of pretty much everything without having to go out and buy every single stock? That is the exact problem that investment funds were invented to solve. They give you instant diversification. You know that old saying, don't put all your eggs in one basket? Funds let you buy a whole bunch of baskets at once.
The classic way to do this is with a mutual fund. Just imagine a giant pool of money. Thousands of people chip in, and a professional manager takes all that cash and goes shopping for a diverse mix of stocks, bonds, whatever. It's like having a pro fill up an investment shopping cart for you. Super simple way to get started.
Then you have the ETF, or Exchange Traded Fund. This is a more modern spin on the same idea. It's also a basket of investments, but here's the cool part. You can buy and sell it on the stock exchange all day long, just like you would a single stock like Apple or Google. This makes them incredibly flexible and easy to access.
And this brings us to a really important difference between the two. Mutual funds are often actively managed. That means there's a person, a fund manager, whose whole job is to pick stocks and try to beat the market. ETFs, on the other hand, are usually passive. They're not trying to be superstars. They're just trying to match the performance of a market index, like the S&P 500. They want to be the market, not beat it.
So, we've talked about the what and the where. But who? Who are the big players pulling the levers behind the scenes? Well, the whole system really leans on one type of institution: banks. But probably not the kind you're thinking of.
You see, there's a massive difference between a commercial bank and an investment bank. Your commercial bank is the one down the street where you have your checking account. They serve you, the public. An investment bank? Their clients are huge corporations and even governments. You can think of them as the architects of the entire financial market.
And their job is way more specialized. They're the ones who help a private company go public in an IPO. That's the moment when you or I can finally buy a piece of it. They're the matchmakers for giant company mergers. They handle the massive, complex trades for big institutions. They're really the grease that keeps the whole machine running smoothly.
And that's it. From the stock exchange where it all happens to the investment banks that make it possible and everything in between. The stocks, the bonds, the funds, you now have the foundational vocabulary. These are the building blocks of the capital market.
So now that the language isn't a barrier anymore, what's the first question you want to ask? Because knowing the terms is just the beginning. The real adventure starts now.